If you're using a 1 minute, if you're using a 1 minute chart, of course, then you're looking at those quick opportunities to grab some scalps, $100, $150. If you even look at the last 30 minutes or so on the gold market that I've been trading, we've absolutely been destroying the gold on these rotations. Has anybody else been destroying gold on these rotations? And obviously rotations are going to be where the big opportunities really are. But obviously if you're looking at that selling gold's just absolutely annihilated the downside. Look. Now, as a scalper, that's an enormous winner. As a scalper, that is an absolutely enormous winning swing. It's just perfection, isn't it? Absolute perfection. Even buying at a higher price like this, I mean, you have to work the order for a few minutes, but obviously you end up getting the trade that you're looking for, because obviously when you're scalping, you're trading for buy-side liquidity, right? That's where you're trading for when you're a scalper. So when I'm a scalper here, I'm trading for sell-side liquidity. So obviously there could have been a little sell-side liquidity there, obviously, and now you've got some sell-side liquidity there. So that's what you're trading for, is that liquidity. I don't know what's wrong with these as trade opportunities. I think they're very, very easy trades. I mean, I think they're incredibly basic to see these opportunities to play out these. Now, obviously, it's about then putting it into context with perhaps a few other things that might be available for you to be able to spot. You know, it's always going to be important to be able to spot if there's a change to something else that's underlying the market that might drive the market outside of these ranges. You know, so obviously, if you're thinking about buying here, the candle size would be against you, the candle volume would be against you simply because of what you see here. You can see that that little sell trade at 92s has just traded 86s, 87s. That's a $500 sell. Been in the market for 4 minutes. So how did I get the sells? Well, it's all about the gold bond blue line spread that we've been teaching everybody for 10 years. This blue line spread is something that as a gold trader you should have been using from day one and understanding it and developing out the thought process behind it. This is the typical blue line spread right here. There's one of two conditions. There's a parallel shifting condition or there's a diverging shifting condition. There's two conditions. So what do we mean by that? Well, obviously a parallel shifting condition is pretty obvious. Two lines dropping and the price is rising. We should be selling it. That's what happened in this area here. You can see that the two lines are both dropping. The price is rising into the top edge. I'm a seller. Parallel shifting condition. Anybody not see a parallel shift? Anybody not see that as an easy sell trade? $500, guys. Incredible, isn't it? $500 on that parallel shifting trade. Nobody? I think that's absolutely glorious. Well, where was the last parallel shifting trade we got on that screen? Well, it's probably not going to lose your attention that we got a parallel shifting sell trade there. You see it? So there's another parallel shifting trade there. The two lines are both falling on a blue candle into a prior swing high. I mean, it's a printing press for money, isn't it? It really is a printing press for cash. Now, this isn't a parallel shifting trade, this one. This one here isn't a parallel shifting trade. Now, you might say, but there's a parallel shift here, isn't there? Yeah, there is a parallel shift in that candle. But obviously the idea is it's very near the bottom edges, and I was just asking for maybe a little bit more into that pool of liquidity. I never took this as a sell trade. If I scalped it, I would have made money, right? You might have been able to see that the dark blue line is still premiumed during that period. So you could have possibly have sold these two candles and then flipped on this candle here. Because this candle here is, of course, a very nice divergent candle. You see the blue line dropping and the light blue line rising. So this is a divergent buy trade for the squeeze to the upside. This is a parallel shift for the press. You see the light blue line is making a significant higher high. I think it should be okay to make some money on this, so long as the dark blue line isn't moving faster to press through, then that's what the trade is. So obviously the idea is is relatively clear, because obviously you then have that macro view in the background as well that you're trying to also tie into this as part of that storyline. And there's a trade that's just gone 92 now down to at 73, 83s. That's a $900 profit into a key dealer's level. So obviously we're going to book some monies into that key dealer's level there. Beautiful trade. You've seen most of that trade live actually, because obviously we showed you when the trade had just started to peel off the top edges here. This parallel shifting sell. I think it's incredible. Absolutely incredible. 40 and 20, Reeve. 40 and 20. Now, a lot of people will look at it and say, but the problem you've got with that, of course, is that it might be a treasury trade. There's always the chance that you're going to end up on the wrong side of the treasury trade, because obviously the gold part of that deal is a hedge spread, of course. And that's always going to be one of the risks, isn't it? That you end up on the wrong side of the treasury side of the trade. So obviously you've got to try and make sure you always ask other questions around these trades as well. You know, obviously if I'm looking at this blue line and I'm trying to deal here, you know, if I can start seeing these arbitrageable type opportunities here, like this trade here, if I'm selling that, I'm buying 20 bonds, but I'm selling 40 bonds, right? So when you see that storyline there, you know, if I'm buying the light blue line to go back to the dark blue line, I'm selling 40 treasuries against that storyline. Now, if 40 treasuries doesn't have a sell side impact on gold, then fair enough, but it really should have a sell side impact on gold, shouldn't it? So we're trying to make sure we kind of understand that as a thing. We try to understand that these should have the desired impacts, but they don't always have the desired impacts. And obviously, if we know that that's going to have an impact on bonds, we might be able to look to see whether it's already having an impact on bonds, or whether it's having an impact on the curve, or whether it's having an impact on the knob spread, or whether it's having an impact on the dollar, for example. And we can look at whether the dollar is really strongly in our favor or really strongly against us. Well, what would you rather be doing on gold just now? Would you rather be buying gold or selling gold? Well, if the dollar's if the dollar is very strong here, and it stays pretty much very strong, I'd rather be selling gold, right? I'd rather be selling gold. Now, I know there's a bit of a revival here, probably because of spreaders coming in on the dollar versus that position, because obviously you can look at the dollar spread there and say, yeah, there's definitely a dollar gold spread available to play into here. But sure, I'd rather be selling gold against that macro backdrop of dollar strength. I don't know about you, but that's certainly what I would rather be doing. And obviously there's individual swings, like this individual swing at the bottom edge. You can see there's some dollar weakness coming in, allowing a very strong exit price into a dealer's key. Because you know, with a stronger dollar, a weaker dollar coming in here, the dealers are going to look at that and say, yeah, let's get rid of that short gold position and let's get our book squared. Get our book squared away. And obviously that book squaring down at 84s has just popped the price back up to 88s. It's made a nice little dent to that upside move, and that's what we're kind of starting to look for when we use any of these as spread opportunities. We can see that same similar trade sell side has been dominating that bond, of course, because the belly of the curve and the back end of the curve is incredibly steep. It's been steep since yesterday morning, in fact, London time. We saw the steepening coming in from the basically the London Open and bonds yesterday, not today, yesterday. And that steeper curve, of course, is driving the bond market. That's why we were such massive sellers of treasuries this morning, was because we were basically selling at the London Open this morning into a bull steepener. And a bull steepener, as you know, I mean, fair enough happening on the belly, but happening on the 2s, 10s, you got to be joking, right? You got to be kidding me on. If that happens on the 2s, 10s, I am absolutely sell side only. So obviously, if I've got that opinion about bonds, then I'll probably be tainted a little bit in my opinion about what happens on gold, right? Because obviously you're going to be thinking in the same lines on your gold trade, and that last sell trade's actually kicked off rather nicely as well in that pullback with a bit of volume. And again, that's a volume story. So if anybody sold the 87 halves, very, very, very good trade. It was an exhaustion print, so you had to be careful up here. So you might not have sold it until you got the break of the 87 there. So that would have been absolutely fine. If you took the break of the 87, you can see it's already made some nice money. Some people might say, but what about the buy trade? Yeah, there's no volume in that buy trade. It's just a free trade, isn't it, at that stage? Remember, I want to be sell side gold, so I'm looking for any sellable excuse. Is that a sellable excuse there on a parallel shift? Is that candle a sellable excuse on a parallel shift? Sure. Obviously, this is an adjustment. Absolutely. You might say, but is that not there for a buy? But look at the difference, an increase in volume versus a decrease in volume. I want to be sell side gold, so I'm not going to be looking for a buy trade unless I'm maybe deep into the bottom edges here. So obviously that's another opportunity to bag and tag some of your lovelies as you retest into the bottom edge here at 83s. That's another $400 paid into your account. So that last swing there, since we started to talk about it, went 92 offered to 84s. So that's around about 800. And then we've gone 87s to 84s. That's about 300. You're well over $1,000 a contract in the last 20 minutes. $1,000 a contract in the last 20 minutes. You're looking at that and saying, what the hell? $1,000, 20 minutes, one lot. A little 5 lot in that, you're $5 up. Nice. Turns out a royal exit at the top edge at 75.15s was a good exit. It dropped all the way down to 75s. I wish I'd bought the bounce, but I didn't. One trade for me so far today on that gold, that oil since the London Open, since Brent came in. It was obviously the buy trade at 74.50. The exit price we shouted live in the room. I would have loved to have bought here in hindsight, but obviously there's a big swing to the downside here, so I'm not buying here in hindsight. I would be looking at this, at the time was a possible retested high into the 25.30 area up here, with a possible swing sell back into this. But obviously, if this value keeps picking up here, I'm obviously not going to get a swing sell value in it. So we're going to have to just leave this one alone for the time being.